Today, we're diving deep into a massive strategic shift at the energy giant Petronas. This is a classic business case study, a story about a huge legacy company that finds itself forced to completely reinvent itself in the face of what some are calling a polycrisis, which is basically when a bunch of different challenges all hit at the same time.
So let's just get right to the heart of it, the one big question that frames this entire story. How does a national energy champion, a company this big and important, react when its profits suddenly collapsed by almost a third? That's a high-stakes problem with no easy answers.
Well, the official answer came straight from the top. The CEO, Tan Sri Tengku Mohamed Taufik, announced what he called a strategic workforce transformation. Now, that might sound like a bit of corporate jargon, but trust me, that phrase kicked off one of the biggest shakeups in the company's entire history. So let's break down what that really means.
Okay, first things first. To really get what's happening, we have to understand the immense pressure Petronas was under. This whole transformation, it wasn't a choice they made lightly. It was a reaction to some really serious financial headwinds.
This is the number that just changed everything. A 32% drop in profit after tax for the 2024 fiscal year. For a company of this scale, that's not just a bad quarter. That is a catastrophic decline that absolutely demands a powerful, immediate response.
And this chart here really puts the scale of that problem into perspective. Profits fell from a really strong $18.2 billion just 1 year earlier, all the way down to $12.4 billion. We're talking about a nearly $6 billion hole that appeared on their books, and it had to be fixed fast.
So what caused this? Well, a huge external factor was, you guessed it, the price of oil. The company had built its entire budget assuming Brent crude would be somewhere in the $75 to $80 per barrel range. But the market, it only averaged about $65. When your whole business model hinges on a certain price, a gap that big is a full-blown crisis.
So, faced with that crisis, what was management's move? Well, they didn't just sit on their hands. They rolled out a really decisive, two-part plan for this transformation.
The plan itself broke down into two main parts. First, what the company called right-sizing the workforce, which, let's be honest, meant targeted layoffs. And second, a complete and total freeze on hiring any new people and on promotions across the board.
Now here's what's really staggering, the human scale of that right-sizing decision. We're talking about a planned reduction of about 5,000 employees. That is 10% of their entire global workforce. It's a huge number, and it was mainly aimed at finding redundancies in their support functions.
The second part of the plan was this really long-term freeze. From June 2025 all the way through to December 2026, that's a full 18 months. They put a moratorium on most external hiring and promotions. The only exceptions they made were for roles they considered business critical, which for them mostly meant jobs in clean energy.
But here's the crucial point, and this is where it gets really interesting. This wasn't just about slashing costs to stay afloat. Petronas framed this as a deep strategic pivot. This next part is all about the business school theory that they used to justify such a dramatic move.
The core idea here is something called portfolio high grading. Okay, in simple terms, what it means is you deliberately shrink the parts of your business that are older and more costly. In this case, they are traditional oil and gas operations, so you can free up that cash to invest in the future. And you can see right here exactly where that freed up capital is going. Petronas is redirecting a full 20% of its annual capital spending away from its core business and pouring it directly into new, high-growth areas. We're talking renewables, green hydrogen, and carbon capture technology. This is that pivot in action.
So why the hiring freeze? Why not just hire new people with those green tech skills? Well, it's a massive bet on what's called human capital theory. The company basically decided to stop buying a stock of existing skills from the outside market. Instead, they wanted to create a flow of new skills internally, forcing the organization to retrain and upskill its current employees for these new jobs of the future.
Of course, a move this huge has a massive social impact, and the company put some measures in place to try and soften that blow. They set up a transition council to support the staff who were affected, and they created a huge $339 million annual fund for talent development, with most of it going through their own internal energy transition academy.
Okay, so this brings us to our final section, and really the central dilemma of this entire case study. Was this radical transformation a prudent, forward-thinking move, or was it a really dangerous gamble?
This balance sheet really captures the complexity of the decision they had to make. On one side, you have some serious reasons to be concerned. I mean, key performance metrics like return on average capital employed have fallen sharply, and a hiring freeze always risks starving a company of new ideas. But then you look at the other side. The company's total assets are still growing, and it's still a vital contributor to the national economy. It's a true business dilemma.
And so we end with the question this case really poses to every business leader out there. Is this kind of surgical transformation a smart, prudent way to future-proof a legacy company for the huge energy transition that's happening? Or does cutting staff and freezing hiring actually pose a dangerous long-term risk to the very innovation you need to survive? What do you think?